All right, welcome back. One of the hottest trades of the year could be getting even hotter. Dollar General set to join the S&P 500 after the close of trading tonight, meaning that if you own a fund that tracks the broader market, you'll likely have a stake in this company. Is it a stock worth owning? We're looking at talking numbers right now. On the technical side of the story is Mark Newton. He is with Grey Wolf Execution Partners. On the fundamental side, Zachary Karabell is president of River Twice Research and a CNBC contributor. Guys, good to see you. Zach, let me kick this off with you. What does Dollar General's inclusion in the Standard & Poor's mean for the stock?
Well, it certainly means that it's been validated by Standard & Poor's, which I guess is about as good as Standard & Poor's judgment is. It's good for liquidity, but with a large cap name like Dollar General trading 300-400 million shares out float, that doesn't matter as much. Look, my take on this name is we all have a limited choice about how many stocks we're going to own individually in a portfolio separate from ETFs, and you got to decide where you're going to make those choices. So I have nothing overly against Dollar General. It may do quite well, and it may go up 10%, but I could probably come up with a couple hundred names that I think are going to do a whole lot better, granted with a little more risk. And I think unless you really feel the economy is going to deteriorate significantly next year and that the low-end consumer is going to have to go ever more into this space, I'm not as excited by it.
All right, so you don't like the fundamental story necessarily versus others. Mark, let's talk technicals. What does the chart look like?
Well, Dollar General still looks quite bullish to me, technically, Maria. I mean, the stock has started to deteriorate a little bit over the last 4 months, but really there's no real substantial sign of deterioration. My thinking is it can still move to new highs. And if you look at some of the charts, initially you'll see the stock has had a good bullish uptrend. You did break trend lines, but you held where you needed to in terms of support. And so the bottom line is the deterioration has really been minimal, and the stock is still within 10% of its overall all-time highs.
Right, and that's
the second
where,
chart.
That's where I'd say 10, 15%, right, which is about the move that would bring it above its all-time highs, is a very healthy move for a stock. But if you've got a suite of other stocks, which I'm sure you could find on technical charts, where you could imagine a 20, 30% breakout. I mean, think of all the cloud names, right?
Granted, I don't disagree with you, but there are a couple of things to also mention here, and that the chart formation since July is what a lot of technicians would call as a corrective pattern in Elliott terms, okay? We actually broke beneath August lows, but since we've regained them, and now the stock has had a decent move up. But if we get over $52, which is, I think, what can happen in the next few months, the stock has a quick ride up to the upper 50s, and I think that's going to happen between now and early next spring.
All right, we'll leave it there. We'll keep watching that. Gentlemen, thanks very much. We'll see you soon.